Finance Core, Topic 2, Forecasting Financial Statements and Free Cash Flows. Readings for this topic include Corporate Finance 5th or 6th edition, Core Principles and Applications, Chapters 2 and 3. Our first learning objective is we're going to forecast financial statements. Later, we're going to evaluate external funds needed, assess growth and external funds needed, understand and forecast free cash flows, and then also create a data table. So let's get on to our first learning objective. We're going to forecast financial statements. So let's talk about the ingredients necessary to forecast financial statements. And by the way, when we talk about forecasting financial statements, sometimes we call them pro forma statements, pro forma. So what do I need to get to my forecast of my income statement and the balance sheet? So we're going to start off with the income statement, and the first number and most important number is probably your sales growth. And to think about sales growth for your organization, you need to think about what is the general inflation level, right? If inflation's 3%, maybe just raise your prices and sales grow 3%. You also look at the overall market growth, any changes in market share, and then your production capacity. Could I even sell more given our current production capacity? And then you're going to move to your operational expenses, also called OpEx. You're going to forecast cost of goods sold. Now you could just assume that it grows at the same rate as sales, or you can specify a cost of goods sold as a percentage of sales. In other words, you can say that cost of goods sold is always 40% of sales because I know that my production costs. And you can do likewise with selling, general, and administrative expense, also called SG&A. You can say it grows at the same rate of sales, or you can specify some percentage of sales that SG&A will be. And then lastly, depreciation. And that's going to depend on your fixed asset forecast. So let's talk about fixed asset forecast, or CapEx, capital expenditures. Now remember, from the first topic, all expenses in an organization could be called OpEx or CapEx. OpEx meaning that they're expensed immediately or in the same year in which they're spent. So that might be materials to produce your goods, labor. And then you have capital expenditures. Those are long life assets that are going to last more than 1 year. So that might be a new truck or a new plant or even office furniture. So CapEx, what that's going to depend on is your current production capacity and your sales growth. So if you're expecting to grow a lot, you're probably going to have to expand your facility unless you have a lot of capacity in the current facilities. And maybe you don't need any new, say, delivery vans because the current ones are half empty anyway. So you could do a number of things to think about CapEx. Here's just some scenarios. You could say that CapEx is 0, so I'll need no additional CapEx to support the given level of sales. So you have plenty of capacity, plenty of vans, plenty of production capacity. You could say that CapEx is equal to depreciation expense. So this would be a simple example that anytime you're depreciating an asset, in effect, you're just kind of replacing it. So as cars depreciate or delivery vans depreciate and computers depreciate, you're just kind of buying them back to maintain the current level of assets. So that's a common thing to assume, is CapEx is equal to depreciation, and that would be consistent with just kind of very low sales growth environment in which you're just trying to maintain the current asset base. Or you can just say that CapEx grows at the same rate as sales. So basically what you're assuming is your production capacity, your fixed assets, is just going to grow with sales. It's just perfectly scalable. Or you can specify that net fixed assets as a percentage of sales, say, remains constant at some level. So there's always some relationship between your net fixed assets and your total sales levels. And then you're going to move down to your interest expense, and that's going to require you to forecast the interest rate you receive on your cash or short-term investments. And also you have to forecast the interest rate and the levels of debt, short-term and long-term. And they have taxes. So we generally just use an average effective tax rate that maybe the organization's been running the last several years, usually between 20 and 30%. Then you're going to, so this is going to get me down to finish my income statement. And then I'm going to move on to my balance sheet. So I need to forecast short-term assets and liabilities. So these will be receivables and payables and inventory and cash balances. And it's very common to have those grow with sales. So whatever you assume up here, maybe you might start assuming that down here. Again, you're just assuming that those relationships hold. Then you have, let's go down to equity. You got retained earnings. Retained earnings is pretty easy to forecast. It's whatever last year's retained earnings was, and you're going to add any additions to retained earnings. However, that's the trick. What is the addition to retained earnings? Well, you're going to have profit the organization earned in your income statement minus your dividend is going to be the additions to retained earnings. So what you need to do is you need to first forecast profit up here and then decide what your dividend policy is. Maybe you just pay a fixed dividend. I'm going to pay $1 million dividend per period, and I'm going to keep that constant. Or you can say I'm going to grow my dividend, so whatever it was last year, I'm going to grow it at some percent. Or you can have a constant payout ratio or payout percent. So for example, I always pay out 30% of my profits as a dividend, so that would be the payout ratio. And then also we have liabilities and stock. So the financing, and this is usually one of the last things you're going to do, is because you're going to forecast your sales, forecast your assets you need, and then what left over is, do I need to finance additional asset growth? In other words, do I have more assets than I have financing for them? So then that'll drive the debt and stock decisions. But we'll talk about that more later in the next topic. So when you do your pro forma financial statement, your forecast of future, you're going to do it in 3 phases. The first pass, the second pass, and the third pass. Most of the work is done in the first pass. In the first pass, you're going to do what we talked about here. You're going to run and forecast your sales and your cost and all that stuff. But what you're going to do is you're not going to mess around with debt and stock at this point. So you're going to just say keep debt and stock constant, no new debt, not paying off debt, not issuing more debt, you're not buying back more stock or issuing more stock. And what you're going to do is you're just going to let the balance sheet forecast assets holding the debt and equity constant. And at that point, you're going to then look to see if your balance sheet balances. Are your assets equal to liability and equity? If not, if your assets are forecasted to be greater than L&E, then you're going to have to decide on financing. And that's going to be your second pass. Your second pass is you're then going to focus on assets minus L&E, right? So this is the value of the assets we have. This is, you can think about L&E, liability and equity, as your total financing. So if assets are greater than L&E, you have additional funds needed, call it EFN, and then you have to make the decision whether you want to, say, close that gap by issuing debt or issuing more stock. However, if you're forecasting that maybe the company's doing so well and we have extra money left over and we've already plowed back a lot of money from retained earnings, I actually have excess money. My liability and equity are greater than assets. I have excess financing. So in that case, you have some good choices to make. You can pay down your debt, you can buy back some stock, or maybe just hold it in cash, or maybe just increase your dividend. So this is the second pass, is dealing with this. Now the third pass, it's kind of a minor point. If you, in your second pass, make changes to cash or debt, that's going to change the income statement because of interest expense. So it's going to put the balance sheet out of balance again. So you might have to just plug a little bit of more debt and equity to get the balance sheet to balance. But we're going to do that in the next topic. So let's do our first pass of this pro forma financial statement. So I'm going to go to the Excel file. I'm in my start file under forecast 1, and here's my model. Again, remember, in this color here, these are all inputs, they're values. This style here are calculations, and then here's an output. And usually I save that for the bottom line of what I'm trying to do in that section. And then here are some assumptions that I'm making over here to the right. And so I've got a lot of this set up, so we're just waiting to fill it in. So sales in 2019 were $1,000. I'm going to assume sales growth of 20% based on my forecast of inflation and working with marketing and deciding what's going to happen with market share and all that and the forecast of the economy. I think we're going to grow 1,000 times 1 plus the growth rate. We're going to have sales in 2020, the following year, of $1,200. And then I'm going to assume that cost of goods sold as a percentage of sales remains at 40%. You can see it is in 2019, 400 over 1,000 is 40%. So I'm going to assume that that remains 40% of my sales is going to be cost of goods sold. So I'm not assuming any more efficiencies or less efficiencies by expanding the output. Those relationships hold. SG&A, I'll keep sales times 20%. That's going to be my assumption of SG&A as a percentage of sales. Depreciation, well, I have an assumption that depreciation remains at 23% of net fixed asset, which it was the prior year. So if you look at that 22.5 divided by net fixed asset to prior year, it's almost 23%. So I'm going to assume that whatever net fixed assets is, it's going to be 23% is going to be depreciated in any 1 year. So one way of thinking about that is you're depreciating about a quarter of your fixed assets per year, or a 4-year life. So now we have EBIT or EBIT. And so I'll take my sales minus cost of goods sold minus SG&A minus depreciation. That gives me an EBIT of 210. Now let's look at interest expense. Now interest expense, I have an equation here which I already filled in. What it basically says is it's 2% times the cash balance plus 8% times the total short-term and long-term debt. But I don't have those values forecasted yet. So let's actually jump down to the balance sheet. The first thing we're going to calculate is cash. Cash is a short-term asset. I'm assuming that short-term assets and liabilities grow at 20%, the same as sales. So I'm going to take my prior year's cash times 1 plus that growth rate. I'm going to hit F4 or put dollar signs in front of E in front of 11. That's going to anchor it. Now the advantage of anchoring a cell, putting dollar signs in front of the row and column index, is now when I copy that formula down, E11 isn't going to turn into E12, which it would if I didn't anchor it. But now I can just copy that down and notice that E11 stays the same. Notice how, or that B13 here turned into B14, B15, B16. And then I'm going to copy that formula one more time. I'm going to hit Control C, and accounts payable is a short-term liability. I'm going to paste that there. So now I have my balance sheet forecasted so far. I have my short-term assets. Now, what did I do with net fixed assets? Look, I just have a formula here. I'm going to assume that net fixed assets is the same as some percentage of sales. I'm going to use 100%. So in order to generate $1,000 in sales, last year I needed $1,000 in net fixed asset. I'll assume that relationships holds, so I'll take 1,200 times 100%. So again, it's just assuming that there's some relationship between the assets you have, which are, say, property, plant, and equipment, and the sales forecast. So now I have my net fixed assets, I got my accounts payables, and notice what I have here for bank loans. Bank loans, 100 last year plus 0, because I don't make any change in the first pass of your pro forma financial statement. What you want to do is assume no changes in debt and equity yet, or debt and common stock. So notice bank loans, prior level plus 0. Long-term debt, prior level plus 0. Total liabilities, common stock, prior levels plus no forecasted change. I have my retained earnings, 75% of net income. So I'm assuming that the company is going to retain 75% of their profit. And now we call that the plowback ratio. What percentage of the profits are retained in the firm for future investment? So it's actually 1 minus the payout ratio. The payout ratio is what percentage of the profits are paid out as a dividend. So let's go back up here and finish our income statement. All right, I got down to interest expense. Now that I have cash and debt balances, that calculates. I'm going to calculate earnings before tax, EBIT, minus interest. Tax is calculated based on the prior year's percentage. So it's just whatever last year's percentage was times this year's earnings before tax. So I did that in one formula here. So last year, 34 over 137 is probably about 20 some percent. So I'm basically using that percentage times the prior year's or this year's EBT. And there I have my net income. Now that gives me a dividend level and a plowback level. Notice my retained earnings is now 75% of net income is an addition to retained earnings. So retained earnings is last year's level plus 75% of profit. So 25% must have been paid as a dividend. There's my total equity, common stock plus retained earnings. And there's my total L&E. Now notice here's what we have. This is our first pass. We're forecasting $129 of net income or earnings after tax. I'm forecasting to get that level of sales, I need $1,620 of total assets. Assuming no changes in debt and common stock, I'm forecasting L&E, liability and equity, of $1,467. Now notice I'm forecasting I need $1,620 in assets, but I only have $1,467 in financing. So if I take the difference between assets minus L&E, there's a gap of 153. That's my external financing needed. External financing. So internal financing you can think of as maybe as this plowback, right? That's internal financing. But if I need to go out and issue more debt or issue more stock, looks like I need 153 more. So that's the end of our first pass. We can also see what it does to a few ratios here. First of all, assuming the company had 100 shares outstanding, there's no change in stock. So earnings per share go from 102, that's net profit divided by shares, to 129. So it looks like a great year. It looks like almost a 30% increase in earnings per share. We'll assume the stock price is $15. I don't need that except for a future when I do the second pass. And let's see what happened to ROE. ROE has gone from 1365 to 1522. So it looks like we're kicking butt, right? However, let's really think about why we're doing well. Well, asset turnover, well, we're not any more efficient with using our assets to generate sales. Our profit margin did actually improve a little bit, so that's good. So it looks like we got a little bit more profitable. It's probably because our depreciation is a little bit lower. So here's actually the big driver is this. The reason why we're doing better is based on the forecast. Looks like we have a higher leverage ratio so far. So notice if let's just change this number to 1.8. What if leverage didn't change? Well, then we're a little bit closer to last year's ROE. So the big driver is I'm forecasting that leverage is going to increase, which is going to increase the profits. I'm sorry, the ROE. So that's our first pass. There's our additional funds needed, 153. And the next topic, we're going to evaluate that external fund needed and talk about capital structure or financing decisions.